Right now, on the 21st of July, 2026, gold is sitting at one of the most contested price levels in modern market history. The $4,000 per troy ounce mark has become a genuine battlefield, with buyers stepping in to defend it every time it comes under pressure, while a hawkish Federal Reserve is doing its level best to stop any further rally in its tracks. This is not just a number on a screen. It represents a tug of war between two powerful and opposing forces. On one side, you have geopolitical uncertainty, central bank demand, and inflation concerns pushing investors into gold as a store of value. On the other, you have rising rate expectations from the Fed, a strengthening US dollar, and improving risk sentiment that could pull capital away from precious metals. In this video, we are going to take you through every major factor shaping gold's price today, and give you the specific levels and triggers you need to watch. In financial markets, round numbers carry enormous psychological weight. They are the points where traders place orders, fund managers review positions, and trading algorithms trigger. The $4,000 level has become precisely that kind of focal point for gold. Buyers have repeatedly returned to this level since gold first crossed it, treating any dip below as a clear buying opportunity. The fact that gold is holding above $4,000 today, rather than collapsing beneath it, is itself a bullish signal to many technical traders. It tells the market that there is genuine, deep-rooted demand at this price. Central banks, particularly from emerging economies across Asia and the Middle East, have been consistent buyers of gold over the past 2 years, adding to strategic reserves and reducing their dependency on the US dollar. That consistent institutional demand forms a natural floor beneath the market. Today, the price action is reinforcing that floor once again, and buyers are clearly not willing to surrender this level without a fight. One of the most significant factors underpinning gold today is the ongoing situation between the United States and Iran. Reports confirm that US-Iran negotiations have been making some progress, which you might think would reduce the risk premium built into the gold price. But here is the reality. Diplomacy is unpredictable. Any sudden breakdown in those talks, or a fresh escalation in the region, could send investors rushing into safe haven assets like gold almost instantly. The market is therefore not fully pricing out that geopolitical risk. It is maintaining a buffer, a risk premium, precisely because the situation remains fluid and could shift on any given headline. This is actually a subtle but powerful form of support for gold. Even as traders weigh the possibility of a diplomatic breakthrough, the uncertainty itself is enough to keep demand for the metal elevated. Geopolitical risk and gold have always moved in tandem across history, and today is no different. Now let us turn to the most significant headwind facing gold right now, the Federal Reserve. The Fed has been sending increasingly hawkish signals, suggesting that further interest rate hikes could still be on the table. This is a direct challenge to gold bulls. Here is the mechanism. Gold pays no yield. It does not generate interest or dividends. When interest rates rise, the opportunity cost of holding gold increases, because capital sitting in gold could instead be earning meaningful returns in bonds or savings instruments. Higher rates also tend to strengthen the US dollar, which makes dollar-denominated gold more expensive for buyers using other currencies, reducing global demand. Today's data from the US Redbook Index, which tracks retail sales trends, showed a year-on-year reading of 7.8% for the week of the 17th of July, down from the prior reading of 8.2%. That softening in consumer spending adds complexity to the Fed's decision-making process, but for now, rate hike expectations remain the dominant market narrative and are firmly capping gold's upside. The connection between the US dollar, Treasury yields, and gold is one of the most important relationships in global finance, and it is on full display today. When the Federal Reserve hints at further rate hikes, US Treasury yields tend to rise. Rising yields attract global capital into US assets, driving sustained demand for dollars. A stronger dollar means that gold, which is priced in dollars on global markets, becomes more expensive for buyers in Europe, Asia, and emerging markets, which reduces overall demand and puts downward pressure on the gold price. Right now, the market is at a genuine inflection point. Traders are debating whether the Fed is truly going to hike again, or whether we are already at the peak of this hawkish cycle. If it is the peak, then yields could be close to topping out, and gold could be positioned for a significant move higher. If the Fed follows through with more hikes, the pressure on gold will intensify considerably. This uncertainty is precisely why gold is stuck in a range above $4,000 but is unable to break decisively free. Gold's story is never simply a US story, and today is a sharp reminder of that. In Japan, analysts at BNY have highlighted a significant fiscal pivot currently underway. The Government Pension Investment Fund, the world's largest pension fund with assets of approximately $1.5 trillion, is reshaping how it allocates capital across global bond markets. As Japanese government bond yields rise, some of that vast pool of capital may rotate out of foreign assets and back into domestic bonds. That kind of capital flow can ripple powerfully through global markets, affecting everything from US Treasuries to commodity prices including gold. Meanwhile, in the United Kingdom, the pound sterling attracted fresh bids today after stronger than expected employment data was released this morning. A resilient pound reflects a relatively robust domestic labor market, and it also affects how UK-based investors and institutional funds are pricing gold in sterling terms. These cross-currency dynamics add yet another layer of nuance to an already complex global gold market today. Let us get specific about where gold could move from here, because concrete levels matter. On the upside, the key resistance zone to monitor is between $4,050 and $4,100 per ounce. A sustained break above that area on solid daily closes would be a meaningful bullish signal, potentially opening the path towards $4,150 or even $4,200 per ounce. On the downside, $4,000 itself remains the critical floor. A daily close below that level would be a significant warning sign for bulls, and could trigger an accelerated test of $3,950, or possibly $3,900 in a more bearish scenario. Short-term momentum indicators are broadly neutral at present, reflecting the balanced and finely poised nature of the current battle between buyers and sellers. The next major catalyst is most likely to come from either a Federal Reserve communication or a fresh headline from the US-Iran situation. Until then, expect gold to remain range-bound but with a slight bullish bias given the underlying institutional demand. So here is the clear takeaway from today, the 21st of July, 2026. Gold is in a holding pattern at $4,000, defended by buyers but firmly capped by a hawkish Federal Reserve. The geopolitical situation around Iran is providing a meaningful floor, but it is not enough on its own to drive a decisive breakout higher. The Federal Reserve's stance on interest rates is the single most important variable to watch right now. If incoming U.S. economic data continues to soften, the case for more Fed hikes weakens considerably, and gold could become the major beneficiary of that shift. If the data remains strong and the Fed doubles down on its hawkish message, then the ceiling on gold could hold for some time yet. This is a market that is coiled, waiting for its next real trigger. The $4,000 level will not hold as a range boundary forever. Watch the Fed, watch Iran, watch the dollar, and position yourself accordingly. If you found today's analysis genuinely useful, please subscribe to the channel and share this video with anyone who follows the gold market. We publish daily breakdowns like this every single trading day.